Imagine a world where the shimmering metal that powers your smartphone, electrifies your electric vehicle, and captures the sun's energy in vast solar farms suddenly vanishes from the shelves. Not because it's worthless, but because it's become priceless. Picture factories grinding to a halt, banks scrambling in boardrooms as billions evaporate from balance sheets. And everyday investors watching their paper promises turn to dust while the real treasure slips through their fingers. This isn't some dystopian fiction. It's the looming reality of a physical silver shortage that's been building for years. And right now, in December 2025, with silver trading at record highs around $66 an ounce, we're teetering on the edge of a cascade of failures that could reshape global industries, economies, and fortunes. The question isn't if the physical silver runs out. It's what breaks first when it does. And the answer could send shockwaves far beyond the trading floors of Wall Street or the mining pits of Peru, touching everything from the renewable energy revolution to the very stability of the financial system we've come to take for granted. As we stand here on December 19th, 2025, the silver market is a powder keg, ignited by a perfect storm of insatiable demand and stubbornly flat supply. A combination that's propelled prices up over 120% this year alone, outpacing even gold's impressive 64% rise. The roots of this crisis trace back to the industrial behemoths that have quietly transformed silver from a mere precious metal into an indispensable commodity for the modern world. Solar panels, artificial intelligence hardware, electric vehicles, and electronics that form the backbone of our digital age. Global silver demand, though expected to dip slightly by 4% to about 1.12 billion ounces this year due to economic headwinds, remains voraciously high, driven primarily by the photovoltaic sector that's gobbling up over 200 million ounces annually to meet the world's aggressive push toward green energy. On the supply side, mined silver production has stagnated at around 813 million ounces, with gains in Mexico and Russia offset by declines elsewhere, leaving a yawning structural deficit for the fifth consecutive year. A shortfall projected at 117 million ounces or more, draining above-ground stocks at an alarming rate, and forcing industrial buyers to scramble for every scrap they can find. This isn't just numbers on a spreadsheet. It's a tangible squeeze felt from the refineries in China, where hoarding has intensified, to the dealers in the United States, where premiums are soaring as physical bars and coins become harder to source, creating a shadow market where the true price of silver whispers far above the spot quotes flashing on screens. But let's peel back the layers and ask the burning question. When the physical silver truly starts to run dry, when the vaults echo empty and the mines can't dig fast enough, what fractures first in this intricate web of paper, promises, and real-world needs? The most immediate crack might appear in the paper market itself. That vast arena of futures, contracts, and derivatives where billions trade daily without a single ounce changing hands. A system built on the illusion of endless liquidity, but now facing the harsh reality of physical scarcity. Consider the COMEX, the New York-based exchange that's long been the heartbeat of silver pricing. As deliverable inventories dwindle to critically low levels, already down to fractions of annual demand, the risk of a delivery default looms large, where traders demanding physical metal find the warehouses barren, triggering force majeure clauses that allow settlements in cash rather than bars. This isn't unprecedented. Whispers of such scenarios have echoed through the halls of finance before. But in 2025, with industrial users like Samsung and Tesla bypassing exchanges altogether to secure direct supplies from mines at premiums pushing $70 an ounce or more, the disconnect between paper and physical grows ever wider, potentially forcing the exchange to suspend trading or reset rules in a desperate bid to maintain order. Imagine the chaos. Hedge funds and speculators caught off guard, liquidating positions in a frenzy, setting spot prices on a volatile roller coaster that masks the underlying panic, while the real metal vanishes into private vaults and factory stockpiles, leaving the paper traders holding worthless IOUs. Yet perhaps the banks break before the exchanges do. Those titans of Wall Street like JP Morgan and Bank of America, who've played the short-selling game for decades, suppressing prices through massive paper positions to profit from the volatility, but now finding themselves trapped in a vice of infinite risk as prices climb relentlessly, with commercial shorts still hovering around 80,000 contracts, the equivalent to 400 million ounces they don't own but have promised to deliver. The losses mount catastrophically with every dollar tick upward, already tallying billions since the year began, and rumors swirl of major institutions quietly unwinding positions to stem the bleeding. When physical runs out, these banks face a margin call from hell, unable to source the metal to cover. They become forced buyers in a market with no sellers, bidding higher and higher in a self-reinforcing squeeze. That echoes the GameStop frenzy of 2021, but on a scale that could threaten solvency, prompting regulatory interventions or even bailouts, as shareholders demand answers and CEOs face congressional scrutiny. The emotional toll here is palpable. The hubris of financial engineers crumbling under the weight of geological limits. A humbling reminder that you can't print silver like you can dollars. And as the shorts capitulate, the wealth transfers from the manipulators to the holders, a poetic justice that Main Street has long awaited, shifting our gaze from the gleaming towers of finance to the humming factories of industry. Another fracture line emerges, one that could halt the green revolution in its tracks, and send ripples through global supply chains already strained by geopolitical tensions and economic uncertainty. Solar giants, the voracious consumers of silver paste, essential for photovoltaic cells, are already paying shadow prices well above spot to secure emergency reserves, with reports of electronics manufacturers offering cash bonuses to jump refinery queues, fearing shutdowns that cost millions per hour. As physical silver depletes, what breaks first might be the assembly lines themselves. Imagine a solar farm project in California, grinding to a standstill, panels half built as suppliers ration metal. Or an EV battery plant in China idling workers because the conductive silver coatings are unavailable, exacerbating the very energy shortages the technology was meant to solve. This isn't mere speculation. With silver's role in AI hardware and 5G infrastructure growing exponentially, a shortage could cascade into broader tech disruptions, delaying data center expansions and slowing the rollout of autonomous vehicles, forcing companies to innovate substitutes like copper at breakneck speed, but with uncertain success, all while prices for finished goods rise, inflating costs for consumers and stoking inflation fears that central banks are ill-equipped to handle in a post-pandemic world. Amid this industrial turmoil, the retail market, where you and I chase coins and bars, could fracture even sooner, transforming from a niche hobby into a frantic battleground. As dealers widen spreads to $10 or more per ounce, switching to pre-orders with weeks-long delays, or outright halting sales to preserve inventory for high-volume clients. Picture the scene: online bullion sites crashing under traffic surges, local coin shops with empty display cases posting sold out signs, and premiums exploding to levels that make physical ownership a luxury for the prepared, while latecomers scramble for scraps at exorbitant markups, fueling a black market rife with counterfeits and scams. This retail rupture carries a deep emotional resonance, evoking the gold rushes of old but inverted, not a flood of supply but a drought that separates the foresighted stackers from the regretful masses. As stories emerge of families cashing in heirlooms only to find the market has moved against them, or savvy investors watching their physical holdings appreciate in real time, a tangible hedge against the fiat erosion that's accelerated in recent years. Deeper still, the exchange-traded funds and unallocated accounts. Those convenient vehicles for mainstream investors to own silver without the hassle of storage might be the first to shatter under the strain, invoking the dreaded force majeure clauses buried in their prospectuses that permit cash settlements in lieu of metal delivery when supplies falter. As vaults deplete and refiners prioritize industrial contracts, ETF managers could face the impossible task of fulfilling redemptions, opting instead to pay out at spot prices that lag far behind the true street value, eroding trust in the system and sparking a mass exodus toward physical alternatives. This betrayal would ignite a panic, with investors flooding dealers and exacerbating the shortage, while class action lawsuits pile up against fund providers, highlighting the fragility of paper proxies in a world where physical possession reigns supreme, a lesson hard learned from past crises like the 2008 financial meltdown, but forgotten in the bull run's euphoria. As these fractures propagate, the global economy itself teeters on the brink, with emerging markets like India, traditional silver importers for jewelry and festivals, facing cultural disruptions, as prices render traditions unaffordable, or nations like China accelerating their stockpiling, further tightening the noose on Western access, and heightening geopolitical tensions over resource control. What breaks first could be international trade norms, as export bans from major producers like Peru or Mexico spark diplomatic rows, or currency wars intensify with silver-backed assets gaining traction in BRICS nations, challenging the dollar's hegemony and forcing a reevaluation of monetary policies worldwide. The human element here is profound. The dreams of renewable energy advocates dimming as costs soar, the aspirations of tech innovators curtailed by material constraints, and the quiet satisfaction of long-term holders who position themselves against the tide, watching as the system they distrusted unravels in spectacular fashion. Building to the climax, envision the tipping point. A major industrial announcement, perhaps a solar conglomerate halting production lines due to unattainable silver paste, triggering a chain reaction, where banks dump remaining shorts in desperation. COMEX invokes emergency rules, and retail premiums hit 50%, all converging in a single, chaotic trading session, where silver gaps up $10 overnight, shattering records and exposing the emperor's nakedness, the illusion that infinite growth can defy finite resources. In this maelstrom, the true break isn't a single entity, but the collective faith in the managed market, a psychological snap that propels prices toward triple digits, as analysts now forecast for 2026, with some bold voices like Peter Schiff calling for $100 an ounce amid unrelenting deficits. The air thickens with urgency, hearts race with the thrill of upheaval, and the narrative shifts from warning to revelation, empowering those who act now to secure their piece of the enduring metal before the fractures become fissures too wide to bridge. Yet, as the dust settles in this envisioned future, not so distant given the trajectories of 2025, we find solace in the enduring lessons. Silver's scarcity isn't a curse, but a clarion call. To value what's real, to diversify beyond the digital mirages of finance, and to hold fast through the volatility that precedes true price discovery. For the prepared, this shortage isn't an end but a beginning, a wealth transfer from the short-sighted to the visionary, where physical ownership becomes the ultimate insurance against systemic fragility. And as we close this exploration, remember that history favors the resilient. Whether you're stacking bars in a safe or investing in miners poised for the rebound, the key is conviction in the face of chaos. The physical silver may run out for the unprepared, but for those who heed the signs, it becomes a legacy of foresight in an uncertain world. Stay vigilant, subscribe for more insights into these pivotal shifts, and let's navigate the coming storm together. Thank you for staying with me till the end. Here on The Scope, we dig past the headlines and uncover the hidden layers history tried to bury. If this documentary made you think differently, hit subscribe. Your support tells me to keep creating deeper investigations. Share this video with someone who loves powerful, untold stories, and leave your thoughts in the comments. I read everyone. A new, even stronger documentary is already on the way. So stay curious, and I'll see you again soon, right here on The Scope.